There are a few more things that I want to cover in Chapter 7, other than just the perpetual method of valuing ending inventory cost and cost of merchandise sold. One of the things that I'd like to talk to you about today is how the different methods that we've talked about um, will affect your financial statements as far as the cost of merchandise sold and the gross profit on the income statement, and as well as the merchandise inventory and how it's valued at the end of the period on the balance sheet. So what I want to start with you today is to look at some examples where they've given you information about each individual perpetual inventory method and how it would affect the financial statements. So I'm going to go to your textbooks. If you'll bear with me for just a second till I can get that up on the screen. And so what you should be seeing right now on your screen is a picture of your textbook on page 358. What I would like for you to look at in particular is a table that they have that represents each one of the different types of inventory valuation methods that we've talked about. You'll remember we talked about the first in, first out method. And in the first in, first out method, if we were using the perpetual inventory system, what will happen is our gross profit will end up being higher than it is the LIFO method. I want you to look at those because, as we've talked about in the past, management can decide which method that they want to value the cost of the ending inventory at, and the different methods will all affect your net income and your balance sheet differently. And so if a company decides that they want to use the first in, first out method, then their cost of merchandise sold is going to be higher, which means the gross profit will be higher, and the merchandise inventory will also be higher. Now, something I want to point out to you that I think is a little bit confusing about the way the book actually has this table set up is that there are two statements that are represented here, the income statement and the balance sheet. And so right here where they've got double rules, that represents the income statement portion of this problem and how the first in, first out would affect the income statement. The second part of this table has merchandise inventory. I think you really ought to know that merchandise inventory is a balance sheet account. It's an asset account. We have talked about that in the past. And so merchandise inventory for the FIFO method will end up being higher. Now, you'll remember that the last time that we met, we talked about the weighted average cost method. And the thing about weighted average, if management chooses to use it, the gross profit and the ending inventory will fall somewhere in between the first in, first out method and the last in, first out method. As you can see, under the weighted average method, the gross profit, which would end up on your income statement, is $12,100. That's actually lower than the first in, first out method, but yet it's higher than the last in, first out method. So the merchandise inventory follows the same pattern. The merchandise inventory for the weighted average cost method falls in between the first in, first out method and the last in, first out method. And again, management can use any of these methods that they want to value their inventory. A lot of times, management might use the first in, first out method if they want to keep the physical flow of goods similar to what the cost will be. Under the LIFO method, the physical flow of goods is not like it is with the first in, first out method. The first in, first out method that management might choose to value their ending inventory cost would be because they might be interested in saving on some income taxes. If you'll notice with the last in, first out method, the amount of the gross profit, which would end up on your income statement, is actually lower than either the first in, first out method or the weighted average method. Because the gross profit is lower, it means your net income will be lower if you use the LIFO method. And a reason that management might want to show their income being a little bit lower is so that when they pay taxes on the income, they will pay less taxes. And our government allows us to do this because they think that if you have some tax savings, you'll reinvest that tax savings back into the company, and therefore the company will grow. And the larger the company is, the more the company grows, the more taxes that the company will have to pay. But the last in, first out from a management perspective would mean that they could have some tax savings, and so that's why they would want to use this particular method. Now, on the balance sheet for the last in, first out method, as you can see, the ending inventory is valued lower than it would be for the first in, first out method and the weighted average method. I really think it's important that you understand this. And these items will happen only when the prices are rising. If the prices of your inventory is falling during a period of time, then the opposite will happen. The first in, first out method would be the lowest amount of income and the lowest amount of merchandise inventory, whereas the last in, first out method would give you the highest amount, and that's only during periods where prices are falling. And as you know, sometimes prices can fall as well as prices can rise. But this example that they've given you in the book is about when the prices are rising or they are increasing over time. So I think it's important that you understand how the different valuation of inventory methods can affect the financial statements. Another thing that we probably need to talk about that we have not talked about is sometimes companies can use what they call the lower of cost or market method to value their inventory. So sometimes inventory can be valued at something other than cost. It might be valued at the lower of the cost or the market method. And companies that will use this will sometimes have things that will happen to the cost of replacing their items of inventory. Sometimes the cost of replacing the items in inventory might actually become lower than the recorded cost that you have in inventory itself. In other words, prices can go really lower, And so the cost of you buying these items could actually go below what you had originally recorded at your cost amount. So in this case, you might use the lower of cost of market method. You might also want to use the lower of cost or market method when the inventory can't be sold at normal prices due to imperfections, or maybe you're in an industry where you're selling clothing and the style changes. And so you're going to have to mark down those items of inventory just to get them to sale. Sometimes the inventory cannot be sold at normal prices because of spoilage or some type of damage to the inventory, or in cases where the inventory becomes obsolete, they can't be sold at normal prices, and so you'll have to mark them down below cost. And so we can use another method for reporting our cost if management chooses to do so, which is called the lower of cost or market method. And when we talk about the lower of cost or market method, one of the first things that we need to look at is a formula that they call the net realizable value. And the net realizable value of the merchandise is sometimes what we also refer to as the market value of the merchandise at the point in time that we are looking at the lower of the cost or market. So in order to determine the net realizable value, we're going to look at what the estimated selling price of that inventory might have been, and then we're going to subtract out all of the direct cost that we think that it's going to take for us to get rid of or to sell that inventory. And so we're going to determine estimated selling price, and then we're going to look at the direct cost of the disposal. So if we've got some items of inventory where the cost or the replacement of that inventory has fallen below the original cost of the inventory, we might have to actually increase maybe our advertising cost in order to get that inventory to sale. So those advertising costs, that special advertising cost, would be considered your direct cost of disposal. So we might also have to pay our salespeople a little bit more, give them some more sales commissions in order to try to give them an incentive to sell that obsolete inventory, or that inventory that's not selling as quickly as you want it to. And so the direct cost of disposal or the extra selling commissions would become a direct cost of disposal. And so the formula to find the net realizable value is really the amount that we expect that we can receive from the sale of this inventory. May have become obsolete, or the inventory that's become damaged, or whatever the problem is with the inventory. Is we've got to determine what the estimated new selling price of that inventory is going to be, and if there are any direct costs associated with the disposal. The difference between the estimated selling price and the direct cost of disposal will give you the amount that you actually feel like you will be able to receive from the sale of this merchandise. So in your textbook, they've given you a problem to illustrate this. And then it says, to illustrate, assume that the following data about an item of damaged merchandise is that it originally cost the company $1,000, but because this item of merchandise was damaged, they know that they're not going to be able to sell it at the normal selling price. So we have to figure out an estimated selling price for that merchandise. The estimated selling price that they came up with for this example is $800. They've also determined that in order to get this damaged merchandise to sell, that they've incurred some selling expenses that are related to that damaged merchandise. For example, if the merchandise is damaged, you might be able to repair that merchandise, and those repair costs would become a part of the selling expenses that would go into the damaged merchandise. But you still may not be able to get the full selling price for that merchandise. In this case, they have estimated their selling expenses to get this damaged merchandise to sell as being $150. So the first thing you would do is calculate the net realizable value of this merchandise. And so we would take the $800 selling price and subtract from it the selling expenses, and that will give you the net realizable value of this merchandise inventory, which is what we really think that we'd be able to get for this merchandise inventory, would be $650. Now, they've also given you another example, which is a link to Best Buy. And it says that Best Buy values its inventory at the lower of cost or market based upon cost and the amount it expects to realize from the sale. And then it is referring back to the information that we just told to you. It says, thus the merchandise would be valued at $650, which is the lower of its cost of $1,000 and its market value at $650. The lower of cost or market method can be applied in any of these three ways here. Do it by each item in the inventory. We can determine the lower of cost or market by each separate individual item of inventory that needs to be valued at the lower of cost or market, or we can place our inventory in certain groups or classes or categories of inventory. So we could lump them all together as a particular category or a group of inventory. Or we could apply the lower of cost or market method to the inventory as a whole. And so they've given you another illustration about that item where we're going to be looking at the link to Best Buy. And so if we look at Exhibit 9, this will give you a clear example of how to determine the lower of cost or market inventory. So first of all, they're valuing inventory items such as Echo, Foxtrot, Sierra, and Tango. These are three different inventory items, but the inventory items are very similar in nature. And so when we place a value on these items, we're going to look at each one of these items, how much we have in the inventory. And first of all, they give you the cost per unit. So to determine the cost that we would already have on our records for the Echo is the ending inventory quantity, which is 400 units, at the cost per unit of $10.25. That will give you the total cost that they've recorded in column E in this example of $4,100. So first of all, they've determined the total cost by taking the quantity of inventory and multiplying it by the cost per unit. So for Foxtrot, it's 120 times $22.50, which would give you a total cost of $2,700. For Sierra, it's 600 times $8, which will give you 4,800. And Tango is 280 units times $14 as a cost per unit, which will give you 3,920. So we determine the total cost first of the items of inventory that we're valuing. The second thing we're going to do is we're going to determine the total market price. And what you're going to do is you're going to take your ending inventory quantity for each one of your items, and you're going to multiply it by the market price for each one of these items. The market price is really the net realizable value, which was your estimated selling price minus the disposal cost. That's how they're getting the net realizable value here. We're going to take, in the first example for Echo, 400 units. We're going to multiply it by $9.50, which is the net realizable value per unit, and that will give you the total market value, which is really the net realizable value at $3,800. So to find the net realizable value of Foxtrot, we would take the inventory quantity of 120 and we will multiply that by $24.10, and that would give us the total market value for Foxtrot. For Sierra, we're going to do the same thing. We're going to take the inventory quantity of 600. We're going to multiply that by $7.75, and that will give you $46.50. For Tango, it's $280 in ending inventory times $14.75, which will give you 4,130. So you have to find the cost first and the market first. Then you're going to determine whether you're going to value each item in inventory separately. If we decide to value each item separately, then what we would do is we would keep up with a lower of cost or market column where we are valuing each item separately. So what we place in the lower of cost or market column is whether the cost of the Echo was lower than the market value. In this case, the market value or the net realizable value is lower than the cost. So we're going to choose the market as the lower amount, which is $3,800. If you're valuing each item of inventory separately, we would look next at Foxtrot, look at the total cost, and look at the market price, market value, the net realizable value total amount. The cost this time is the lower, so we would carry the cost over and put it in the lower of the cost or market method. So really what you're doing is you're just looking at the cost and comparing it to the market, choosing the lower of each one of these. So with Sierra, the cost was $4,800, the market was $4,650. The lower would be the market, so we would choose the lower amount or the market amount to go in the lower of the cost or market method. For the Tango, the cost is $39.20, but the market is $41.30. So the lower of these is $3,920. That's what you would choose. Remember, this column is when we're valuing each item of inventory separately as to look at which is the lower of the cost or market. Once we get through with this, we're going to total our lower of cost or market method. We would also look at the cost and look at it. And then we're finally going to place a value in our records that shows that the lower of cost or market method is lower than the original cost. You will find the difference between these two. So if we're looking at the lower of cost or market method, if we're looking on an item by item basis, you can see here that the cost was 15,520. That cost of 15,520 would be compared to the lower of the cost or market. The difference is 450, which means that our cost will need to be adjusted. What we would need to do, and something that they are not showing you in this example, is record a journal entry which would lower the cost of our merchandise sold. And to get our cost of merchandise sold actually to work properly, we would need to show that our ending inventory has declined by $450. That was the difference between the total lower of cost or market and the total of the cost. Since the total of the cost was higher than the lower of cost or market, we need to value our inventory at this lower amount. So what we would do is we'd find the difference between these two, which is 450, and we will have to reduce our merchandise inventory by $450. So if we created a journal entry to do that, our merchandise inventory would have to be credited for $450, whereas our cost of merchandise sold would actually need to be showing a decrease in the amount for $450. So what we would need to do is we would need to show this item as decreasing the amount of our ending inventory, which would make our cost of merchandise sold increase a little bit more. And then that way our financial statements would end up correct if we have chosen to use the lower of the cost or market method. So on an item by item basis, the amount of the merchandise inventory cost should be reduced by $450 to make our merchandise inventory account agree with what needs to go on the balance sheet. Our balance sheet amount should show that the merchandise inventory has decreased by $450. So on our balance sheet, we would reflect the total cost of our ending inventory at $15,070. It would no longer be reflected at $15,520 because we had some items of inventory that may have been obsolete, or they may not have been damaged. Inventory items, we couldn't show them at their normal cost amount. We went to value those at the lower of the cost or market method. Now, we've also said that management might choose to use these as maybe an inventory as whole. And if that's the case, what we would do instead of coming up with this column right here is we would just leave this off, and we would record our cost, and then we would record our market value of those ending inventory items. and then we would compare the totals of both of these. So you can see that the market price, if we're comparing totals, is 15,472, which is lower than the cost. So we would simply subtract the two of these amounts and it will give us $48. So if we took the 15,520 cost and subtracted the market, which is the net realizable value that we get if we're valuing this as a whole amount, if we subtract the two, it's going to give us $48. And $48 would need to be shown as a reduction in the merchandise inventory. So we would create an adjusting entry again that they haven't shown for us to do that, where we would debit our cost of merchandise sold for $48 and credit our merchandise inventory for $48. When we credit the merchandise inventory for $48, it will bring us down to the 15,475, and that's what you would report on your balance sheet as the ending amount of inventory. So companies can use the lower cost of market method if they feel like it's a better method of showing the actual cost of the merchandise inventory. So that's the lower cost of market method. Another thing that we need to be aware of is that on our financial statements, we're going to have merchandise inventory in the current assets section. And in this case, notice that on our financial statements, they're actually showing which method that they used to value their ending inventory. In this case, the company used the lower of cost or market, and that was at 120,000. They also used the first in, first out method. So some of their inventory items could have been valued at first in, first out. Some of their inventory items could be valued at the lower of cost or market. What I want to emphasize to you is that on the balance sheet, you're going to show which method that you've used. That way the users will be more informed about the inventory valuation methods and how they will affect the financial statements. The ending inventory, I want to emphasize, is always going to be a current asset that shows up on the balance sheet. Now, something that can also happen for our company is that we might experience inventory errors. You'll remember that when we are doing the perpetual inventory system, at the end of the accounting period, it's always a good idea to physically count the amount of the merchandise inventory. So companies will count the amount of the merchandise inventory and verify it with what they have in their computer records. If the physical count does not match the perpetual inventory records that we have recorded in our ledger accounts, then what we will need to know is that these errors can make our financial statements be reported incorrectly. And so sometimes we might have errors in our physical count of ending inventory. We might also just made an error in calculating the FIFO method or the LIFO method or the weighted average method. Something else that we need to think about when we're counting our inventory at the end of the period is whether inventory was in transit. You might remember that we talked about shipping charges in the last chapter. And if the terms were FOB shipping point, then the purchaser would pay the shipping, and it would become the sellers at the shipping point. So the let me restate that again. If it was FOB shipping point, the purchaser is going to pay the shipping, and so the purchaser is going to carry it to the seller's door, and the merchandise will be that of the purchasers. So if we're valuing inventory at the end of the period, we've taken a physical count. If we leave off the inventory that was in transit, then our inventory records will be wrong. So you have to really take into consideration the terms that you have given to your customers for shipping terms. Also, something that we have not talked about would be consigned inventory. And what consigned inventory is sometimes the manufacturer might decide that they don't want to have the responsibility of selling the merchandise. So they might ship the merchandise to retailers who will act as the manufacturer's selling agent. And so the manufacturer in this case would be called the consignor. They're going to retain the title of the goods until they're sold. So even though they've sent it to a store, it's still going to be considered the manufacturer's inventory. And so if it's sitting in another place somewhere else, we might leave that accidentally off of our inventory count. So we have to be sure at the end of the period when we're counting our inventory that we take into consideration if we have any inventory somewhere else that's being sold for us. Some common types of consignment basis stores you might be familiar with would be sometimes you can have furniture that's sold on consignment. And so if I took an antique table to an antique store and asked them to sell this piece of furniture for me, then technically it's still my inventory. I am the person that has given it to the seller to sell for us. And so if that inventory has not sold, then it's still my inventory, and I need to include that in my inventory count. So if I'm the consignor, I retain the title of the goods until they are going to be sold. So if the manufacturer sends the inventory to a store to be sold for them, then that inventory is their inventory. And so these inventory errors are going to affect the financial statements, and it's important that you understand that. And what I really would like for you to look at is Exhibit 10 in your textbook, which has the effect of inventory errors on the current period's income statement. And let's take, for example, ending inventory, because we've talked a lot about our ending inventory. If our ending inventory is counted wrong and it's understated, what will happen is the cost of merchandise sold will be opposite of that. It will be overstated. Cost of merchandise sold affects the income statement. And if the cost of merchandise sold is overstated, then when we subtract our cost of merchandise sold from our sales, it will make our gross profit become understated. So if the ending inventory is understated, our gross profit will be understated too, and our net income will be understated for that period of time. What that means is our net income that we've shown to our stockholders or our creditors is wrong. It's under the correct amount. If, on the other hand, our ending inventory is overstated, which means that we've counted it wrong, but the inventory we're showing is more than what we really have, then the gross profit is going to be wrong, which will make your net income wrong. Your net income will be overstated if the ending inventory is overstated. So this is what will happen to the income statement. And so you might notice that they also have included beginning inventory here. If you estimate your ending inventory, or if you value your ending inventory wrong on your income statement for one period of time, that ending inventory will become the beginning inventory in the next period. And so the beginning inventory will also make the income statement wrong. And so if the ending inventory is understated in one period of time, the beginning inventory the next period of time will also be understated. And if the beginning inventory is understated, then it will affect the gross profit as being overstated. And if gross profit is overstated, it affects net income as being overstated. So this is a chart that you might want to look at and study to help you to understand the effect of inventory errors on the income statement. Now, inventory errors will not only affect the income statement, they will also affect the balance sheet. And so let me go back and see if I can find the balance sheet. There it is. The balance sheet, if the ending inventory is understated on the balance sheet, then what it means that on the balance sheet, merchandise inventory will be understated. The merchandise inventory, as you know, is a current asset. And if your current assets are understated, it's going to affect your total assets as being understated, and your owner's equity will be understated because the net income was also understated during that period of time. If your ending inventory is overstated, then your merchandise inventory on your balance sheet will be overstated, and that will affect your current assets as being overstated. Your total assets will be overstated, and your owner's equity at the end of the period will also be overstated because your net income would have been overstated. And so it's important to understand how errors affect your financial statements. And so that's about all I want to talk about for this particular chapter. Did feel like we needed to at least look at some of the other items that were in here. I want you to be sure and study the lower of cost or market method and the inventory errors, how they affect your financial statements. That's important. But I really want you to concentrate on the perpetual method of calculating your cost of merchandise sold and your ending inventory with the three main methods that we discussed, which were the LIFO method, the FIFO method, and the weighted average method. And so that's all that I want to talk to you about today. So I'm going to stop sharing this with you, and I'm going to stop the recording of this too. So